Hi, it's the 30th of October and welcome to our 5-minute tax update. This month, we will have a look at local and international developments of October 2020. We also have the pleasure of having with us Christos Papamarkides, our VAT partner, who will give us a quick update on recent important VAT developments. So let's begin. Our first development relates to a decree that was issued for the submission of the tax returns for 2019 by employees and self-employed individuals who do not prepare financial statements. The decree further extends the deadline for the submission of these returns as well as the payment of the relevant tax up to the 30th of November 2020. An amending regulation has recently been issued providing clarifications on the submission of revised income tax returns. As per the recent amending assessment and collection of taxes law, these cannot be submitted during a tax examination. It is clarified, amongst others, that before a tax examination begins, taxpayers will be given a period ranging between 1 and 3 months to submit any revised tax returns. Where there is a request for the issuance of a tax clearance certificate, the date of such request will be considered as the date that the examination begins. As such, revised tax returns should be submitted either prior to the clearance request or at the time of the request. Although VAT is outside the scope of our tax webcast series, there have been some important VAT developments recently, and for this reason, I am pleased to have with us our VAT service line leader, Christos Papamarkides, who will give us a brief update. Christos?
Keris, thank you for the introduction, and let's have a look at these VAT developments. A new article has recently been introduced in the VAT law, primarily to combat tax evasion and tax fraud. It applies from 1st October 2020 and provides that a customer, a taxable person for VAT purposes at the time of the transaction who acquires the goods for business purposes must account for VAT on acquisition of specific types of high-value goods based on the reverse charge provisions. These types are mobile phones, game consoles, computer tablets and laptops, integrated circuit mechanisms such as microprocessors and central processing units prior to their integration into end-user products. This provision applies where the recipient is a taxable person for VAT purposes at the time of the transaction and acquires the goods for business purposes. For these supplies, the seller does not charge VAT on the sale of the goods, provided that the customer's VAT number is indicated on the invoice issued. Where the customer is not already registered for VAT, such purchases will be taken into account when determining whether the customer has exceeded the VAT registration threshold. As from 1st July 2021, a penalty of €200 per VAT return will be imposed where the reverse charge provisions are not correctly applied. The total penalty may not exceed €4,000. It is strongly advisable for all business to review their transactions and ensure that the reverse charge was applied correctly for both overseas and specific local transactions. The VAT law has also been amended to be harmonized with the quick fixes provisions of the relevant EU directive. The amendments are effective as from 1st January 2020 and apply to cross-border supply of goods within the EU. They include provisions for call-off stocks arrangements, chain transactions and intra-EU supplies. For more details on quick fixes, please refer to our alert. Keris, back to you.
Thank you, Christos. Moving on to international developments, On the 6th of October, the European Council announced an updated EU list of non-cooperative jurisdictions for tax purposes. As a reminder, such list refers to non-EU jurisdictions that have failed to implement the reforms on tax governance. As such, Anguilla and Barbados were added to the list, while Cayman Islands and Oman were removed from the list after having passed the necessary reforms to improve their tax policy framework. Following this update, 12 jurisdictions remain on the list of non-cooperative jurisdictions. On the 25th of September, the EU Commission announced that it will appeal to the EU Court of Justice the General Court's judgment on the Apple's state aid case in Ireland. The case considered whether the adoption of a favourable method by Ireland to determine the taxable profit of Apple is considered as state aid. The Commission's opinion is that the General Court's judgment raises important legal issues relevant to application of state aid rules to tax planning cases, and therefore it was felt that such important issues should be clarified at the highest level within the EU judicial system. We will close off today's tax update with a brief reminder of the deadlines coming up. There are no upcoming deadlines other than the 30th of November, which is the new deadline for the submission of the 2019 tax returns by employees and self-employed individuals who do not prepare financial statements. This concludes our tax update for this month. Thank you for watching.